Jeb is out of town. He is in North Carolina. We were like two ships passing in the night here earlier in the week. I flew out to Michigan on Sunday. He flew out this morning to North Carolina, I believe, with the boys. So anyways, he has gone through, given us all of his real estate slides. We're going to go through the data on the mortgage side, everything you guys want and need to know. If you have any questions, as always, throw them up in the chat. We will get to questions as soon as we go through the data. So appreciate all of you early arrivers sticking through the joys of our new microphone. All right, so if we look here, weekly available inventory, so it's up 36.7% over last year. That's the big news there that we look at every week. Some people are making a point of saying, well, it's still continuing to increase through October here. But if you look the last few years, the peak has pushed off a little bit further in the year, and it will definitely level out in the next 30 days or so. So we will keep an eye on that. In terms of locally for us, Orange County, minus 0.27%. Week over week, and Huntington Beach basically level 3,594 throughout Orange County, 227 units active listings for sale in Huntington. So not a whole lot of movement for us here locally. Jeb highlighted a couple things here. All of those markets there in red are the ones that we're seeing inventory increases, not just year over year, which is pretty much consistent throughout the country, but relative to 2019. So if you look at this, Alabama up 1.6%, Dallas-Fort Worth up 2.6%, Denver a more significant amount, up 15% from where we were in 2019. Jacksonville 47.9, and that one's been the big leader there for several months now. Nashville up 10.1%, Phoenix up at 37%. So depending on where you're at, you'll see different numbers as to where we are, and that's probably the most relevant number because we can all look back and say, what did the market look like in 2019 in my area? Was it tight? Was it level? And that's kind of where we're transitioning back to. And when we get to the interest rates, we'll talk about that and that role that affordability plays in that. So already have some good questions here. You guys, if you're popping in, keep throwing the questions up. We will absolutely get to those. Weekly new listings. So 6% more new listings. So we talk about supply and demand. Supply is up. We just looked at that in the active listings. Demand is also trending up. 6% more new listings, or supply continuing to trend up. You can probably tell these are Jeb's charts. 6% more new listings this week than last year. It may possibly be because rates are coming down, people getting comfortable listing their homes. But we will see how that plays out over the next few months. In terms of new listings, where are they up the most? Grand Rapids, Jacksonville, again, they're up. But relative to 2019, still less new listings than what we were seeing because most people are in a home they're comfortable with and in a really attractive interest rate. So there has to be a pretty strong motivator to move. We talk about the big ones, death, divorce, job transfers, things of that sort. So weekly inventory change, total national inventory from 725,249 up to 731. Same week last year, it went up from 528 to 534. So about the same size, but just from a higher starting point. The all-time bottom was in 22 at 240,000. The yearly inventory peak for 2024 is at 731. So we are at the peak, the highest level of inventory. For context, in 2015, we were at 1,188,000. So almost 1.2 million. We're about 500,000 shy of that right now. So weekly new contracts pending. I jumped ahead of myself here. This is showing where we are in terms of demand. We actually had 63,000 new sales pending, and you'll see that's a little uptick. It's not a huge uptick, but a little uptick, a little better than we were in 2023, a little worse than we were in 2022, but definitely trending in the right direction. 2022 is kind of where we saw demand or properties going under contract fall off a cliff there at that point. So median price, you guys know I don't love median price as a great measure, but we can use it year over year to kind of see seasonal trends. So currently $389,000 median home price, well above 22 and 23. So when you look at this, that gray bar shows you September of 2022 prices dropped by 7% on a median level. So it doesn't mean that home prices across the board dropped 7%. It meant that more affordable homes were selling, and the midpoint where half of the homes were above and half of the homes were below moved downwards. And you can kind of see there's some seasonality to that as we move into the end of the year. So we'll likely see that median continue to trend down, even though the paired sales analysis, the FHFA index, Freddie Mac has an index, Black Knight's index, all of those, and Case Shiller are still showing year-over-year appreciation, although it's moderating. So we talked last week that this week here is all about jobs. So yesterday we got JOLTS, the job opening labor turnover survey. Today we got ADP. Tomorrow we're going to get the weekly claims, and then the big one is on Friday with the non-farm payrolls for September. But we had a little bit of negative reaction yesterday morning that was offset by all of the news coming out of Israel and a little bit of flight to safety that improved interest rates. But in terms of this, what I wanted to show, there were about 300,000 additional job openings, and the market didn't like that. Job openings means likely pressure on employers to pay higher wages to fill open positions. The more important data inside there is the hires rate and the quits rate. So you can see the green line and the blue line, both of those continue to trend down. And what does that tell us? It tells us that employees are not super eager to test the market right now, in contrast to where we were in the middle of COVID, where people were quiet quitting, just not showing back up to jobs. You could switch jobs and get a nice increase. Right now, it's kind of status quo. Employers are not hiring and employees are not leaving because it's not a weak market out there, but it's not the strong market that we had seen a few years ago. Job turnover, this is the rates of hiring, quitting, layoffs, and openings. So if we look at it, the layoff rate, employers are not laying off employees. So no one, for the most part, you have seen some fairly high profile companies with big layoffs, but for the most part, layoff rate is at really low levels, but quitting down, hiring down, job opening rate down, even though it did tick up yesterday. So the market basically shook off what could have been a bad headline JOLTS number, because the internals there tell us that we are continuing to see the trend over the last few months, which is a cooling jobs market. So today we got the ADP jobs report. You'll see that pretty green line there. So March, April, May, June, July, August, saw that number going lower and lower and lower. And then today we got a bigger number. But scale is important here because if we look at this 3-year chart, you can see it's a little bit of an uptrend, but relatively flat at relatively low levels. So I was going to look up what the replacement level is for the US economy. I think we had 145,000 jobs, 147,000 jobs created per ADP. So private jobs, they don't include government stuff because the government doesn't use ADP for payroll. But when we look at that, 147,000 jobs is below replacement level. We need, it's a couple 100,000, 225, 250,000 new jobs to keep pace with population growth before we even account for immigration, legal and illegal, which is pretty much untracked over the last few years, but really big numbers of immigration. So the most important thing we want to talk about in terms of interest rates, at this point, everything is data dependent. And for the last couple of years, what is that data? Inflation data. Is inflation coming down near the Fed's preferred measure? And then jobs. Is the job market really tight? Do we still have really low unemployment? And is that having increasing pressure on wages that would likely lead back into inflation? So right now, we're, as we talked about, tomorrow, we get the weekly claims. Those are important, but we've seen them disappointing in terms of those who are looking for a weakening jobs market, because we're not seeing a big uptick in unemployment claims, but we're also seeing the continuing claims remain elevated. So once people go on to unemployment, they're having a harder time getting off, but not a lot of people are going on unemployment. Friday, we get that NFP data. ADP does not have a strong correlation to the weekly or the monthly jobs report, so can't really read too much into it. But if we were to get a hot number on Friday, it could be bad for mortgages and interest rates. Next week, I believe we have one of the inflation reads. It should be CPI. I'm sure one of you has the data at hand. If Jeb were here, I would look it up while he was talking. But I believe we have CPI coming. But inflation at this point is definitely taking a backseat to the employment information, and it's all been not strong, but a little bit better than expected here. So I wanted to show this one. We've been looking again here at the spreads between treasuries and mortgage-backed securities, or treasuries and mortgage rates, because that's what you guys care about. That green band is what the historical range is, from 1.7 to about 2%, meaning wherever the 10-year treasury is, mortgages for the most well-qualified conventional borrower should be about 1.7 to 2% higher than that. We had been way up in the threes for the better part of a year, and it's been trending down, and it's taken a nice downturn here recently. Last Wednesday it was at like 2.28. We're at like 2.34 today, but we still have a quarter to 3/8 improvement in interest rates relative to Treasury. So if the 10-year Treasury doesn't come down at all, we would expect at some point to see another nice improvement in mortgage rates. And it won't happen overnight. It will slowly just sort of normalize over time as we get to whatever the new normal is in terms of interest rates. So with that, many of you are going to ask questions about interest rates, about locking your interest rate, what you should do, what comes next. Do I refi now? Do I wait for better rates? The best thing we can tell you is that although there is no crystal ball, technical analysis does a really good job of picking up market psychology and where it's at. So you see these two aqua lines, that is a down channel in 10-year Treasury yields. So we're just under 380 right now. We had got as low as the about the 360 range. So it's up a little less than 1/4%. That's been offset, those spreads that we were just talking about coming down. So really from the best level of the 10-year, mortgages are up about 1/8, while the 10-year is up almost 1/4%. But what we want to look at, let's look at this chart here. This is, so you'll notice this is the same chart, but with some annotations on here that I think will be helpful for you. These yellow lines, or yellow circles, I wanted to point out, when we get to the bottom of a channel, and this works just the same way when we're going up in interest rates, when we get to the bottom, you probably want to lock, because it's likely that we're going to give back and come kind of towards the top of the channel. When we get towards the top of the channel, it can be nerve-wracking, but that is when you most likely want to float. The chances are that this channel is going to hold. The trend will play out over a longer period of time, especially when you see a longer term trend like this, which takes us back all the way to what, May of this year. So we're going on 5 months of this. We've tested the bottom a couple times. We've tested the top twice. I missed one there. I should have circled 3 times before. We didn't quite, that blue arrow there. What I wanted to point out is we don't always get all the way to the top before making another run to the bottom, but the last 2 moves didn't get all the way to the top or really all the way to the bottom. We've now over 1, 2, 3, 4, 5, 6 trading days kind of run up and touched the top of that channel, and it's held. So to me, what that tells me is that the market is conflicted, cautiously optimistic. They're not buying treasuries. They're not moving the yields back down lower, but the top of that range is holding. So they are looking for some positive data on jobs, on inflation, comments from the Fed to see that hold and move back to the lower end. What I would say is technically the intermediate target for the 10-year, if this channel holds, is 3.25. And if you look, the next run down, if that took 30 to 45 days, would likely get us down there. And that would be rates 0.5% better than where they are right now. Not predicting it, not using it as a crystal ball. You've seen we don't always run all the way to the bottom of the trend, but it is going to be dictated by the data over the next few weeks. So what does that mean for us here? In terms of mortgages, we saw last week we were up 0.04% week over week. This is up 0.05% week over week. So less than a 0.1% increase in interest rates over the last couple of weeks, but it is like death by paper cuts. Every day is just a tiny, tiny bit worse. We'll get a little bit of it back one day, and then again, just continue sliding worse. But the important thing is that rates are still really, really good. When we look relative to a year ago, most loan types are about 1.25% better. We are near the 1-year lows, a little off of what we set about 2 weeks ago. So what does that mean? 30-year fix is about 6.25. The most well-qualified borrowers, especially those refinancing, if you have 25, 30% equity in your home and a 760, 780 credit score, it's likely going to be better than that. Same thing here on the FHA, 5.75. Most of our clients with 640, 680 and better credit scores, they are able to do better than that. Same thing with the VA. So with that, appreciate you guys bearing with us while we go through that. It's a little bit boring hearing one person walk through 15 minutes of charts, but we've got some questions here backed up, only a couple of them. So it's a little bit hard with Jeb not being here. I don't have anyone to talk to while we're waiting for more questions. So if you have a question, mortgage related, refinance related, real estate related. Jeb is the expert on that. I have flipped over 50 homes through my time. I'm a real estate investor. I own multiple properties, condos, single family, multifamily residences. So we can definitely give you some information on that side. So if you have any questions, throw them there in the comments. We will roll through them and get the questions answered. So Bill says, did I mess up not locking my rate yesterday? I close in 15 days. You didn't mess up, because the reality is rates are about the same as they were yesterday. We were worse on Monday, better on Tuesday, a little worse today, but for the most part, it's about flat, almost identical. So did you lose something? Did you give up something that you couldn't get? No. At this point, depending on your risk tolerance, you guys have heard us say this a million times. You need to know yourself and your own tolerance for risk. If you're not a gambler, if you hate any level of risk, go ahead and lock it. But we do have a couple of ISM reports tomorrow, in addition to the weekly claims. That could move things. I don't think we're going to see a big movement tomorrow before Friday. Friday, it would take some unexpected movement in terms of payroll data to really get us a big amount of improvement, or to make things much worse. So from that perspective, what we will be looking for, the headline, the thing that will get headlines, the thing that could move the market, is if you saw the unemployment rate tick up. We were at 4.3. I think it went down to 4.2 last month. So we see that continuing to trend up. But the reality is super likely that we're going to see and about what is expected, and just continue trending along here. We need some form of unexpected data. So unexpectedly positive and strong for the economy would be bad for interest rates. Something unexpected and negative for the economy, jobs, would be something that would move us back towards the bottom of that range and see some improvement. So hopefully that answers your question. You didn't mess anything up, but if you are still wanting to lock, if you're a little bit of a gambler, wait through Friday. If you're nervous, you may want to call your loan officer and just see if you can get that thing locked. We got Christine chiming in here saying hello from Rhode Island. We appreciate that. Don and Bev, I don't know if it's Don or Bev. It may be Don and Bev, but one of them's here. Says, late again. Thanks as always. No, thank you for showing up. Thank all of you guys for asking questions. Love for Puppies always shows up and has a ton of questions. Says, hi, guys. I'll have to let Jeb know since he's obviously not here. Rational 35 has a comment here. We're dying out here in Texas. No buyers. Texas and Florida are kind of the areas that we're seeing the biggest amount of weakness. You saw increases in supply, not seeing as much demand there as elsewhere. But even the worst market, and I say the worst market because it's obviously a very desirable market for most people, is Austin. They're down. They're down from the peak, probably double digits by most people's estimation or tracking and figures. But we're not talking 20, 30% down. Those markets are definitely different, definitely interesting, and we will see if we get follow through in this rate rally and we get rates another 0.5% lower. What does that do in terms of demand? So we know where supply is at. Supply is trending up, but not at spectacularly high levels. It's just supply growth is outpacing demand growth. So it's definitely moderating and slowing down the growth in prices, or in some areas like Texas and Florida, even stopping it entirely. Jamie Ma, who I will actually be talking to here after we get off the show, says hello from San Diego. Thanks for joining us, Jamie. Thanks for reaching out this week. Definitely appreciate that. But let's look here. Rob095. I'm closing on brand new construction at the end of the month, getting a $15,000 credit, did not pay any points. On the loan estimate, box A and B have very minimal charges, but box C is almost $5K. That is totally normal. So for those of you playing at home, and if you've never seen a loan estimate, or if you saw one, you don't remember, box A are your first party fees. You're paying them to your mortgage lender, to the bank, to the broker, anyone who is directly working with you on the loan. And those are zero tolerance. They cannot change. Once they are disclosed to you on a locked loan estimate, those fees cannot change. Box B are things that you cannot shop for, also generally minimal. You'll have an appraisal in there, which can be anywhere from $500 to $1,000, depending on the property type. If you need a market rent survey, that type of stuff. A credit report can be anywhere from $50 to $100. You'll have some minimal things like tax service and flood cert fees, but that's box is generally going to be less than $1,000. So now what comes in box C? Box C are things that you can shop for, such as title insurance, such as settlement services. So depending on where you are, would it be an attorney? Would it be an escrow company? Would it be the title company doing your settlement services? So when we look at that, that is far and away the biggest box. Now, if we got $5,000 in that box, my guess is that's a fairly high purchase price. Is it 700,000? Is it a million? Probably not a $250,000 purchase if we're looking at $5,000. Now, we talked about things you can shop for. Well, on a purchase that's already been negotiated in the contract, by the time you get to me or your loan officer, we're just looking at the contract and it says, this is the titlement company. This is who is handling settlement. And we're going to reach out to them and get those third-party fees. So while you can shop for them, technically, if you want to shop for them, if you have someone that you want to use, you need to negotiate that with the seller. And in this instance, you would have got absolutely nowhere with it, because with a builder owns the mortgage company. That's how they're able to give you a $15,000 credit, because they're just taking money from one pile of theirs and putting it in another pile of theirs. So that's the way you're able to get that credit. They most likely own the title and escrow company as well, and oftentimes a few additional settlement services in there. So it is always going to be in the contract. That is essentially going to be non-negotiable with them. But in this situation, let's say we had 5 there, 1,500 in box B and 1,500 in box A. It's $8,000. We got a $15,000 credit. They're covering all of it. But you didn't really get a chance to shop for it. So, Rob, hopefully that answers your question. It's definitely not anything to worry about. Definitely pretty typical of what you would expect to see. Joe says, a 44-year-old first-time buyer. I purchased a single-family home a month ago in a nice LA County neighborhood. Was this a bad time to buy? Why would it be a bad time to buy? Would be my question. Why would you be thinking it's a bad time to buy? Rates had improved a little bit by a month ago, so hopefully you got some benefit of that. It was before, right before the Fed meeting, so you probably locked about a month before the cut, which should have got some of that benefit there. In terms of desirable markets, first-time buyer, there are first-time buyers, believe it or not, in high-price markets like Southern California that buy $2 and $3 million homes for their first home. But if you bought an entry-level home, 600, 800, $1 million in most markets, we are still seeing strong demand in entry-level homes. Those are the people that are hitting prime home buying age, 32, 35. They're getting married, they're having kids, they're getting job promotions, they want to own a home. So there's nothing there that tells me this is a bad time in a strong demand market. But the most important thing, just what I said, those people that are entering prime home buying age at 44, not uncommon for someone to be a first-time buyer. We're seeing first-time buyers trend older in age. When I started back in the 90s, 27, 28 was the typical age of a first-time buyer. It's closer to 34, 35. So if you look at that, do we have some that are 44? Yeah. Do we have some that are 27? Yeah. But the sweet spot there is about 35 years of age. And as we talked about, most of those people are doing this not because they're saying this is an ideal time to buy. They're saying this was the time in my life where I got to the point that it made sense, where I need a home, I want a home, I can afford a home, I have a stable relationship, stable job, good finances. So from that perspective, Joe, there is absolutely nothing to worry about. And probably the most important thing, if Jeb were here, he would say the most important thing, have a long-term time horizon. If you're going to be in that home 5, 7, 10 years, you're going to build up equity by paying down principal every month. It's going to slowly go up over time in terms of appreciation, and you're going to have a fixed housing cost. And hopefully, especially depending on where you bought, that 6, 12 months from now, you'll get the opportunity to roll that down to a lower interest rate. And when that time comes, we would love to be the ones to be able to help you with that. So I'm going to throw the referral link up here. If you are anywhere in the country, Jeb has an awesome network of realtors. We have a buyer in Sacramento that got connected with his great team up in the Sacramento area here recently. We had a few others that aren't jumping to mind. But we talk about the importance of pros that are on your side, that will negotiate for you, that will listen to you, will understand your needs, and then translate that into the best properties in your market. Use that link. Jeb can get you connected with a realtor. In about 25 out of the 50 states. On the mortgage side, you'll get connected with us. Right now, 80% of those inquiries are refinances. It went from about 1% of those inquiries to about 80%. Many of you bought in the last 6, 12, 24 months and are at a higher interest rate. Some of them, it makes absolute sense to do. Others are in a gray area, and others, you got in early or in one of those dips in interest rates, and it may require a little bit more movement down. We're building and keeping a long list of people that we're just doing a rate watch, that here's the trigger that when we hit that point, we're going to help them get into that. So if we can help you with that decision, if it's reviewing a loan estimate, we do a lot of that. Probably got 7 or 8 loan estimates in just in the last couple of days. Go through those numbers. I would say about 2/3 of the time, there's some money to be saved there. And the other 35% of the time, we can go through it and give you peace of mind and say, hey, do you like this person? They're giving you good terms. Go down the path that you're on because it's a good one. So if you're looking for peace of mind, you want a second opinion, go ahead and use that link and reach out. We'd love to talk to you about your purchase, your refinance, and Jeb can get you connected with a realtor. So, Rob, this is a good follow-up question. Should I expect to pay close to that when I refinance? And then follows up 600,000, wondering if refinancing will be similar. It should not. Some of this is going to depend on where you are in the country. So I think you're still here, Rob. Throw that up as to where you're at, because here's what's really important. In California, $600,000, our box C would be probably $1,200 or $1,300. And this is an area that's important on refinances. Most of the loan estimates I'm seeing coming over in California, they're $1,400, $1,500, $1,600. And I look at it and I go, hey, we have a really low priced provider that does a great job for us. So we can save you 100, 150, 200 bucks. Probably not a big deal. But occasionally you will get someone send over a loan estimate and they've got $2,500, $3,000 in box C. And you're like, it's a good rate. Box A looks okay, but why are we wasting $1,500 down here? There's no need to do that. So big picture, Joe or Rob, you're not going to need to pay that much, most likely. But I will say other parts of the country, I'm kind of surprised when I look up, when I have a client in New Jersey and you go, ooh, title insurance is a good bit more expensive there. Areas like Florida that have an intangible tax, a mortgage tax, you can have a chunk. That won't show up in box C, it'll show up in box E, but you can have higher closing costs. So Winchester, California, Rob, when the time comes, make sure you reach out to us. If you want us to put you on a rate watch now for when the time comes, the rates get there, I would be happy to do that. But box C at a 600,000 should be somewhere $1,300, $1,400, $1,500 for you. And that is common. You're, for whatever reason, just on purchases, you're looking at higher costs, both on escrow and title, everywhere in the country, not just in California. So we've got a chunk of questions here. So Love for Puppies always has interesting questions. Love for Puppies, I think you're an undercover underwriter or Fannie Mae operative or maybe a government tester, because you always have these interesting underwriting questions to make sure we're giving you guys the right answer. So it depends on the length of the adjustable. If it adjusts in 60 months or less, they have to qualify at 2% over the start rate or the fully indexed rate, whichever would be higher. Anything longer than that, then we no longer have to qualify you above the start rate. So if you're doing a 7-year ARM, a 10-year ARM, anything of that sort, we're going to qualify you at the start rate. So the answer is it depends on how long we're looking at this. Oh boy, we have some fun trolls that love showing up here and sharing their opinions, no matter how wrong they are. We get this question a lot. T Yat says, have a Section 8 renter willing to move in. I will profit $500 after expenses. Would you take or hold out for potential $800 to $1,000 profit a month by a non-Section 8 renter? Listing is 3 weeks old. Depends on where you are in the country. You have to know your market. I had this exact situation. We had a unit over in Long Beach, came available end of the year, took us a couple of months to renovate it because it was in pretty rough shape, not because it was a bad tenant, it's because the tenant had been there for 25 years. Before we bought the property, they were already there. And we go to the property manager and he goes, when we get this thing dialed in, it's tip top shape, that's $2,500 a month. I said, it sounds like a lot. I'm not sure it's 2,500. We let them run the ad at 2,500. We were getting applicants. We weren't getting the applicants we wanted. So I said, let's drop it to 2,295, see what happens. And we ended up getting multiple applications. We got a great tenant in at 2,250. So from that end, it took us probably 6 or 8 weeks. We left some money on the table. We probably should have started where I wanted to be at 2,295 to begin with, but they were pretty confident and they showed us some numbers that made me believe that maybe we could get 2,500. So you got to ask yourself, if we're leaving $300 on the table, but you get someone in there right now, if it takes 2 months to get $300 more a month, it's going to take you 6, 8, 10, 12 months before you recoup those losses. What I will also say, people fear Section 8 renters, like, oh, you're a bad person, or they're likely to be rough. Section 8 renters are getting government assistance. they do not want to lose that government assistance. So they are possibly more likely to treat your property with respect and make sure they make their monthly payment on time than a non-Section 8 renter. So if you feel like you can get more not renting it through Section 8, and it's not going to take you too long to rent it, possibly hold out. But if you were of the mind that this is a good tenant, get them in right away, help someone out, it could be a good route to go. So we got We Win. I went to junior high with a guy named We Win. He doesn't live in Maryland, so I'm assuming that you and he are not the same person, but interesting fact only to me. Hello from Maryland. Can you remind me about the general rule about interest rate drop for refinancing? So what we say is take 125,000 divided by your loan amount. So if you have a $250,000 loan, that gives you 0.5% you need to save. If you have a $500,000 loan, at least 0.25%. What I will say is people's response to this when we run the numbers does vary by region of the country. We just talked about Florida has a mortgage tax and an intangible tax and more expensive title insurance than what we have in California. So if you're only getting a quarter, 3/8 savings and you've got 5,000 or 6,000 in closing costs, even on a 0-point loan, relative to 3,000 or $2,500 in costs, you may want it to be slightly higher. But what I would say is, for any of you watching at home, and you want to know, does it make sense to talk to a loan officer? That is a really good test to determine is now a good time to start the conversation. So take 125,000, divide it by your loan amount, and you may want to add 1/8 or 1/4 to it if you have a bigger loan. If you have $1 million loan, it's going to tell you, hey, 1/8% improvement in interest rates is worth it to refinance. Most people aren't going to refinance every time the rate drops 1/8%, although I have had clients in the past who would. So know yourself, but it's a good time to start a conversation with a loan officer when you're seeing those numbers, and we can dial it in and kind of guide you from there. So what do we got here? Habib has a comment. Really more Tampa and surrounding areas are totally flat. Even the rate cut didn't make much difference because prices are still high and seems like the biggest issue is affordability. 100% correct. The biggest issue everywhere is affordability. We have limited demand because of low affordability. There is not a lack of people who want to own homes. There's a lack of people who are in the market to buy homes because they don't feel the affordability is where they want or need it to be, depending on their qualifications. And as we talked about, areas that are having issues with additional supply, the Tampa market, especially the suburbs, as you get further out, there's new construction, there's a lot of homes. So everything has its own issues. So you have to know where you're at, know your market, and know what things are looking like. What I would say here is the rate cut didn't make much of a difference. It was 2 weeks ago, 3 weeks ago, however long ago it was. And mortgage rates are flat since that time. We have only seen a 1% improvement from the worst levels. And at the worst levels, it was rough. There weren't a whole lot of people that could afford. So we went from way above what people want to a little above what people want, with the hope that we're going to get in that range where most people are getting rates in the 5s, government loans, FHA, VA, maybe in the high 4s. But you're going to see over the coming months, it takes time for that data to trickle in. And there will be an uptick in demand, even with just a little bit that we've seen in a drop in rates right now. Is it going to change things where we go from 5 to 6 million sales a year, where we were, during COVID, even pre-COVID, or do we just stick here at this 4.2 million per year? It will trend up. We would need rates significantly lower to get back anywhere near the 5.5 million sales a year. But I also don't think 4 to 4.2 is the right level, or the level that we will see if rates moderate further. So Don and Bev, again, we're starting to see a pickup in buyer interest, but also a pickup in sellers, some old stock rolling off too. So not sure which way we're moving, but uncertainty often equals some buying power. Again, know your market. There are markets that are still very, very strong and buyers are having a tough time. But if that's not your market, you need to be working with a pro on the real estate side that really has their finger on the pulse and can tell you what's possible, what's happening, what's moving, that when you find the home that you're interested in, they can look at that data, not just how long it's been on the market. You can see that on Redfin or Zillow, but what is going on in that area? How long does it typically take a home to sell? How much are prices cutting before they sell? Are they getting asking price? Are they getting 98% of asking price? Are they getting 96% of asking price? These things are really important for you to know. But Don brings up a really good point, or Bev, whoever's here asking those questions, that you have to know your market and know what's happening. So, Love for Puppy says, in your experience, are you seeing a lot of homes with property taxes assessed at much higher values than they're appraising for? You never see that. They just the assessors. It varies greatly from state to state. Like the way they calculate it, some of them will only they will assess it, and then the taxes are based off of a percentage of that. They are almost always well behind the curve in terms of keeping up with where home prices have gone. So accurate, even with the sale price, would be most likely for us in California. Prop 13 makes things a little different because the government can only raise the taxes or the assessed value 2% per year. So with that, they're behind the curve. And when a home sells, it will get reassessed. If it was a market sale, meaning listed in the multiple listing service, it is going to be reassessed for what the sale price is. So in terms of seeing things behind the curve where they're or ahead of the curve where they're assessed for more than what they're worth, don't see that at all. And it varies around the country. So, Donna Bev, do you do investor loans too, or only owner occupied? We do everything. Obviously, investors are a smaller percentage of the market, but talk to a few listeners to the show today that are looking at buying multiple units here in California. We're running numbers a couple of different ways. We have some great resources for non-owner. Typically, like our investors that are the best for our owner occupants are not necessarily going to have the best terms for whatever reason for an investment property. So, from our end, for those of you that don't know, we are a non-delegated correspondent, meaning that we close the loans in our own name, but we've got 50 investors on the back end where we're looking, saying who has the best pricing of all of those to place that loan with. So the cool thing is it gets closed in our name. You're only dealing with one set of disclosures, only dealing with us. But we already have that investor in place that's going to get you the best terms by brokering that. So, good fun one here. Kids Corner. I just refinanced my home and closing tomorrow. I was able to get 4.62 with a $6,100 credit. I was surprised, to be honest. For whatever reason, we always get comments like this, and there's 50 things unsaid there that we don't know. Was it a 10-year term or was it a 30-year term? Was it a government loan? Was it a conventional loan? I'm going to say it was a government loan because there are no conventional loans going out in the fours. I'm going to say it was less than a 30-year term, probably 15 or 10. I have one locked at I think 4.624 right now. It's a 10-year at 30% loan to value with an 800 credit score borrower, and they're certainly not getting a $6,100 credit. So would love to see the locked loan estimate on that one. The numbers are available and out there, but unique situations along those lines. Siete says local credit union has a program with zero down. Are they similar to a VA loan? They would be similar in the sense that you don't have to make a down payment, but that would probably be the only similarity here. Likely to have mortgage insurance. If they're not doing it with mortgage insurance, it's absolutely a portfolio loan, and that will be accounted for in the margins that they are looking for. Probably not going to go as low in credit score as a VA loan will do. Probably not going to go in anywhere near as high in debt to income ratio as the VA loan would do. So in a perfect world, if you're looking to put zero down, hopefully you served at some point, because the VA loan of all loans ever in the history of the world is essentially the best option out there, especially at zero down. But there are options out there. Navy Fed has a zero down that doesn't require you being a veteran. Don't see a whole heck of a lot of them being done because they aren't the same program and aren't as good. So Jose, what's the lowest interest rate in the conventional loan? This is a conversation we have to have all day, every day. Sent numbers out to a listener about a week ago, and he followed up and said, well, I'm just kind of torn. I like your numbers. The closing costs are low, but I got a better number, but it has kind of high closing costs. I said, it's not a better number. On any given day with rates, we saw at the top of the show, conventional average rate is 6.25 right now. That means on the rate sheet, anything from 4% to 8%, and maybe even a little bit wider than that, is available. So from that perspective, do you want it? Are you going to get it? So Kids Corner Circle Back is a 15-year term. So again, shorter term, small loan, super high credit score, you can get one of those ultra low interest rates, ultra low relative to 2024 terms, but it's not really relevant. Very few of our clients are opting for the absolute lowest rate. And in many situations, it's not possible. You can't pay all of the costs required to get it and maintain a compliant loan. So it's like a bell curve. If you look at 6.25 being the average rate, are there a lot of loans being closed at 6? Are there a lot at 6.5 where they're getting a lender credit? Yeah. The further you get out from that, either lower or higher, the less and less loans that you'll actually see being done. Barry, a good VIP viewer, listener, and client, purchased here with us in California about a year ago, says if you do a DADU on a paid off home, do they assess the whole property? He pays really low property taxes. So the ADU or any other addition, you add a master bedroom to your house, you add an ADU, a JDU, a junior ADU, any and all of that is going to trigger reassessment in California. Other parts of the country, almost anything you do, they're going to look at that property when they do the annual reassessments and be able to change it. He's in California with Prop 13. It's limited to 2% annual increases, but if you do a substantial improvement to your home, they do get to assess that. Those of you guys that have been here for a long time know back during COVID, we put a pool in at my house. That triggered a reassessment. They don't just get to go and assess me to market value, but they go, what is the value of that improvement that you put in the property, the pool in this case, the DADU in Barry's case, and they're able to add that to the value of the home. What I will say, kind of going back to the question that Love for Puppies had, is that the cost of my pool was like 2 times what they added to my assessment. So they're pretty reasonable about that. And if you're able to put in a pool super cheap for $25,000, you were your own general contractor. A buddy of mine about 10 years ago, he acted as his own general. He just subbed out the work and he put a pool in really, really cheap. You can show the receipts, show them what you did. They would probably do even less of an assessment at that. So let's look here. And Barry follows up with, wants to get it permitted, but doesn't want to get the property reassessed. If you permit an improvement to your property, the assessor is going to get notified and they are going to reassess you. Ooh, this is a good one, and I wish Jeb were here to put his 2 cents in on it because he would be a much better answer. But Joey Ballgame says, is now still an okay time to list a home? Not sure how a mid to high priced home will sell in October to November. It's that or wait until spring. So a lot of it comes back to, again, knowing your market and having a pro that you trust that can show the data, that can go in my zip code, in my neighborhood. How many homes are for sale now? How many have sold in the last 12 months? What percentage of the sale price were they selling for? Not only would we need to know that, we would need to sit here and do some research and have access to that data. So if you're in Florida, if you're in Pennsylvania, where Jeb and I don't have that, we need a trusted real estate pro that can go through that. What I would say, things definitely slow in November and December. In my experience, what I see is attractive homes that are in neighborhoods that people want to live in, that have updates and upgrades that people want. They're going to sell any time of the year. When one of those trophy properties comes on the market, and use that term loosely, I'm not saying something that you're going to see on HGTV. I'm just saying something desirable in that market, whatever that may mean. Could be a great lot, could be a home that wasn't improved for the last 50 years and someone wants to move in and have those raw materials. But with that, I don't necessarily see a huge reason to avoid the holidays, but a pro can walk you through the data for your market and tell you exactly what that looks like. So what do we got here? If you guys have any questions, throw them up. We got about 15 minutes here, and if there's good questions, we'll continue to hang out. Love for Puppy says, why are conventional loans not assumable? It would unlock some inventory for people that purchase with low rates and small down payment who need to sell and move. That's not really from the lender's perspective what they're interested in. All loan types are basically priced for how long the market expects them to be on the market. And the way Fannie Freddie is written, they just are not assumable. So investors in Fannie Freddie mortgage-backed securities can know that. On the government side, the government decided this was a positive thing, especially for veterans. Veterans can get PCS, can get moved around the country, need to move quickly. And that assumability, especially with other veterans getting PCSed into a local market area and base, can be very helpful. I don't know why we don't have it on conventional loans, but I wouldn't expect it to change anytime soon. What do we got here, guys? John just pipes in to say hi. So we got a lot of you guys here. I want to make sure I didn't miss any questions up higher here. Looks like we got most of your questions answered. There's 99 of you here. If anything pops up, let me know. But for the most part, we're kind of in a holding pattern here with interest rates. A lot of people that bought in the last couple of years benefiting from being able to refinance. For most people, my suggestion is to do it low or no cost. I know a lot of the call centers that our clients are talking to are getting these spectacular numbers where it's a really low interest rate, but they go, but they're adding $20,000 to my loan amount. You have to ask yourself, are you willing to trade $20,000 of equity for a $100, $150, $175 lower payment? Or on some of these lower loans, $12,000, $15,000 added to the loan amount to save $89, $95, $105. If you believe that rates are going lower, or that there is a good chance that they'll go lower, you are much better served by keeping costs to the minimum, not paying points, not paying a bunch of origination fees. That's a fun one. We talked about that last week. I've been seeing more and more of this on the LEs coming across. Saw one today, it said 0.22 discount points and a $2,500 origination fee. An origination fee is points. So are they doing anything against the law by putting it out there that way? No, but that would be to me a giant red flag if someone sends you over a loan estimate with discount points and an origination fee. It's just a way of moving the peanut around and telling you you're paying less than what you actually are in that situation. So this is a good one. Steve Clara. Hey, my name's Steve from California. So California, we talk about, we are blessed. Not only because as a mortgage originator, about 40% of the loans done nationwide are done in California. We got higher average loan amounts. So good for a mortgage originator, not great for home buyers, but we also have lower closing costs. So what I would say on that loan, we talked about box A, box B, box C. You should have anywhere from $0 to $1,500 in box A, unless you're paying discount points to buy the rate down, which I don't suggest. We already went through that. Box B, if you need an appraisal, if you don't need an appraisal, let's say box B could be anywhere from $50 to $150. If you do need an appraisal, $1,000 to $1,200. And box C in California on that loan, $1,300, $1,400 should be your max for box C. We do have a $225 recording tax in California, and your recording fee is probably another $100. So for most people, I tell them it's pretty safe to say you're looking at anywhere from $1,500 to $3,500 in California in terms of closing costs. But you asked an important thing here. Anything out of pocket if I do a streamline. So you're at 7.5, you're asking about a streamline, probably an FHA. Most likely you will need to come up with some money out of pocket. Lenders are not paying the huge rebates now that they have in the past. That rebate is required to give you a credit to cover enough that you would come in with nothing. There is a maximum mortgage calculation on an FHA streamline that limits how much you can borrow. We can't just add everything in there. So if you're interested, use that referral link below. Would love to run through the numbers with you. We can get you an accurate estimate of what that looks like, show you what that maximum FHA mortgage calculation is. So that would be my best advice. But at 7.5, you should be able to get that much lower in the current market without paying a whole heck of a lot. And remember, when we're saying not paying anything out of pocket, part of the reason is you have impounds with that FHA loan. And we're getting the point of the year where there's a lot of money in there and we need to reestablish it with the new lender unless somehow we're able to take that loan back to the same investor. So you have some prepaids, a good chunk of prepaids, and then you're also going to skip 1 month of payment. So there's going to be at least 30 days of interest between your current lender and the new lender. So hopefully the people that you guys are talking to are walking you through that so that you can at least see where all the money is going and do that debit and credit, just adding up the dual entry bookkeeping there and going, okay, cool. I understand where the money is going. I understand why my loan is increasing, or I understand why I'm bringing money in at closing and how and why this is still better for me than my current financing. This is an interesting one. Anu says, permitted addition in the past somehow not reflected in the square footage and county records, while asking for a correction trigger a reassessment. If you bought it after the improvements were done, it should not. It's a question I would anonymously reach out to the county assessor's office and go through with them. They can absolutely answer that for you. I don't believe that it should, because the value of those improvements should have been reflected in the purchase price that you paid for the home, because I'm assuming that you did not do those additions that never got reflected on the title records. So Val with a very good question. Do you do loans in Washington state? Absolutely. Like I said, 25 of about 50 states we can cover as a company. I have 7 or 8. We're adding 3, 4, 5 more in the next few months, or about 12, 13 of those I will cover directly. Our team is licensed in all 25 of those states, so I can get the information, get everything set up, structured for you. Even if it's a state that I'm not personally licensed in, your loan officer on our team will get you the quote and cover those numbers, but I would be your primary point of contact on that. Joyce with the crystal ball question. When do you anticipate interest rates actually going down? When we get data that confirms the direction that we are going. I believe rates are going lower because I believe the economy is slowing, and going to slow further. If I'm wrong and the economy doesn't slow further, maybe rates stay at this level. We talked a couple times here. If I sound like a broken record, I apologize for boring you guys. But the best thing we can do is look back to history. Over the last 40 years, 44 years, there's been 8 cutting cycles back to 1980. The average across those cutting cycles is the 10-year Treasury drops 140 basis points before the first Fed cut, which we just hit. And from the first Fed cut to the bottom in 10-year Treasury, it's about 1.5%. Now, that cutting cycle generally lasts 1 to 2 years. If we take the Fed at their word and the dot plots, they're going to go slowly and deliberately all the way out through 2026. So that would tell me we would just continue to have a slow downtrend throughout next year into 2026. If the downturn in the economy accelerates, they will move faster and rates will drop quicker. So could we see that happen in next year? Absolutely. But this kind of goes back to why I answer this question. If someone has $300 in monthly savings on the table with a no-cost refi today, why would you not take that? We don't know for a fact that rates are going lower. We don't know when they're going to go lower. So if you can do a loan for $1,500, for $2,000, and you have a $400 or $500 monthly savings, just say, hey, with the early payoff penalty to my lender, I'm not going to refinance in the next 6 months anyways. So over that 6-month period, I would more than recoup the cost of this loan. I've got lower monthly payment, I've got better cash flow, and I've given myself the optionality to roll down later in the future. So that was an additional answer above and beyond the question that you asked. Love for Puppies says, do you think job creation or unemployment affects the Fed's decision to cut rates more? Over time, they're going to move in lockstep. You see anomalies from month to month because we have the establishment survey that tells us how many jobs were created. And we have the household survey that tells us what the unemployment rate is. They don't move directly, but with each other. So you'll see anomalies from month to month, but over time, they're going to move in the same direction with each other. Joey with the follow-up here. If the home doesn't sell by mid to late November, does it look bad to take it off the market until April, or would I just keep it listed? I know time on market doesn't look great to all buyers. In a market now where most of that data is available, where Redfin and Zillow, you can see the history of it. There's no way really to spin it that it's a positive. Can't see that that's a positive, but to most people, it's not going to be a negative either. Would it surprise someone if a home didn't sell before the holidays and the seller said, I'll wait till Super Bowl and bring it back on in the spring, especially in areas that experience weather, whether it's snow, whether it's hurricanes, anything of that sort. It's reasonable. So again, I would defer to a real estate professional in your area, and hopefully they have data. Everyone has an opinion. If I have an opinion here and you guys go, bullshit, show me the data, there's no opinions that I express with you guys, nor does Jeb, where we don't have data to back it up. Is the data right? Does it guarantee that I'm never wrong? No, but it's at least a factual data-based opinion, and I would want some data in this as well. Every year is different. Markets change over time. So looking at information from the holidays in 23 and 22 is not necessarily going to tell you what's going to happen in 24, but at least they would have a data-based opinion there to share with you. Here's an interesting one. Bill says, owning a home in a rural area with refinancing from conventional to a USDA have benefits? Probably not. The reason being the USDA is going to have lower interest rates. And you go, whoa, I want a lower interest rate. But if you have 20% equity in your home, the conventional loan's not going to have mortgage insurance. The USDA is always going to have mortgage insurance, both an upfront premium that gets added onto your loan amount and a monthly premium that you pay. So you might be able to get a lower monthly payment with the USDA, but is it the right call over the long haul? I've never seen anyone refinance from conventional to USDA, and I'd be hard pressed to see a situation where that would be the best decision. But absolutely, run the numbers. Talk to a loan officer. Reach out, have them do it. I don't know where you're at. We'd be happy to do that for you and kind of go through those numbers and help you figure out what the optimal solution is. We're almost at the end of the hour. Don't really see a whole lot of other questions there. So I would just leave you guys with this. We've got in the last, let's say 6 weeks, I'm going to go 125 inquiries from people looking to refinance. Many of them have shared loan estimates. Many of them have told us conversations they're having with other loan officers. We've talked about this on the show. 80% of loan officers are worthless. If you're talking to a kid in a call center, doubly worthless. If they work for a national lender in a call center that advertises on the Super Bowl, the World Series, giant billboards everywhere, you're paying for that. And most importantly, those call centers have sales meetings every day, and they talk about scripts and pitches and how to tell borrowers what to do. It is shocking to me how many loan estimates come over, and it is the only loan estimate. It wasn't an option, it was the option. Here, we can do this. And every time, it's a great interest rate, and it is trading a ton of your equity for that great interest rate. When we take 15, 20 minutes and go through that information and say, I can do that. I can do those terms. I can do those terms cheaper for you than what they can do. But I don't want you to. If you want to, that's fine. If a borrower is adamant, they want to pay 2 points and get the absolute lowest interest rate, we go through the numbers and I show them a 0 point. I show them a no cost. They look at all three and they look me in the eye and say, thank you. I understand. I want to pay the 2 points. That's your decision. No one else should make it. So if you're talking to someone who's presenting that to you as if it is the only option, I would run, especially on FHA streamlines, VA IRRRLs. You have to save 0.5%. I've talked to a lot of people who have one of those loans at 5.5%, 5.625. And when we look at it, they have to pay a chunk of money to get to that 0.5 point. A 0 point loan will not get them over that bar of 0.5% savings. And magically, someone sends them out a loan estimate. Yep, you're eligible. We can do this. And you look at it and you go, that's not a good trade. Sometimes no action is the best action. And in those situations, that's why we have this big rate watch list, saying, okay, let's run the numbers and figure out when and where this would make sense for you. And we're just going to look at this list once a week and go, okay, 2 of these 52 people are now eligible, as long as rates start trending down. Over the last 2-3 weeks, rates haven't trended down. So no one jumped off the later list into the now list. But at some point, we do expect it to happen, even though there are no guarantees. So Joyce followed up here. Thanks. Need to email you regarding refinance options. We would love to do it. Love to put some good numbers together for you. Any of you who are watching and listening, 108 of you here, I appreciate you joining. If I don't see any questions here in the next couple minutes or next couple seconds, we'll probably bounce. But appreciate you guys showing up, asking good questions. Appreciate you guys using that referral link, reaching out, giving us the opportunity to run numbers for you. Even if that it truly is just reviewing someone else's numbers and you go, those are good numbers. That's the guy that did your purchase for you. That's the girl that did your purchase for you. And they're giving you good numbers. We are busy enough that we're not going to try and fight to take numbers from someone else who's earned your business and deserved them. That is the exception rather than the rule in most cases. So from that perspective, guys, again, I really appreciate you all showing up. Hopefully, if you're in the business, in the market and need help with anything mortgage or real estate related, use that link. If you have any questions, you always can just shoot those over to us at info@theeducatedhomebuyer as well. Jeb and I both get those emails. If it's real estate related, he'll get back to you. If it's mortgage related, I'll chime in and put my 2 cents. What I will say, if you are thinking of reaching out, be prepared right now. Just that the market is a little bonkers. We do have a ton of inquiries. We're doing our best to get back to everyone. Rather than an hour to get back to you, it might take 4 hours. We might get back with you the next day. But to make the best use of all of our time, make sure you have your mortgage statement available. If you've talked to anyone else, send over the loan estimate, send over the mortgage statement. And that's not for me to look at and go, oh, we can beat them by $500. It's to look at it and go, are you in good hands? or can we save you money? How is this structured? How has someone walked you through this before? So those are the things we look at. Would love to talk to you about it. Again, I appreciate you spending the hour with us. We will be back next week with Mr. Jeb to pick up the real estate side, and hopefully we'll get a good jobs report on Friday, and we can tell you that we finally made that move back down to the lower end of the mortgage rate range. All right. Have a great week, and we'll see you guys next Wednesday.